Hi everybody, this is Kevin Gormley with Leading Edge Financial Planning, and today I wanted to share with you the information around 2016. So for those of you that have been following Charlie and I, you know that we do not believe that short-term performance is important, and the reason why is because the more we focus on short-term weeks and months of what's doing well, it's really the enemy of building wealth, because we constantly want to find out what's doing well and get into it, and running after or performance chasing is a great way to actually knock down your ability to build wealth. So with that, let's look at Q4, and let's just look at some of the messages that Charlie and I felt were very important for us to be reminded of in Q4. So first of all, the U.S. stock market actually had a really decent fourth quarter. Now, the perception of most people is it grew by more than 4.21%, because after the election, the night of the election, if you remember, markets went down 900 Dow points, which was just a couple percent, but the market did pretty well the rest of the fourth quarter. But I'll show you the data in a second. But the U.S. market on average does about 1.8% positive since January of 2001, and this one was 4.21. International developed stocks, these are the developed countries outside of the USA, and they were down a little bit more than 1/3 of 1% in 2016 Q4. Emerging markets was down negative 4.16% after a fantastic first three quarters. Then the final quarter, emerging markets went down. And then global real estate, which when the election was over and many people thought asset classes would do well, global real estate got hammered because people thought that the Fed would raise rates, which they did raise rates in the fourth quarter by 1/4 of 1%, and the expectations are that they will raise again 3 times this year. Now, do we at Leading Edge Financial Planning believe that they will raise 3 times this year? We don't make a comment on it because it's really hard to know what's going to happen in the future. There's so many factors that could cause the Fed not to raise rates, and there's factors that could cause the Fed to raise rates even more. So anyway, the bond market really got trashed in the fourth quarter, mostly because of the fear that interest rates would rise very fast. So the U.S. bond market was down almost 3%, global down 2.21%. This was the fourth quarter, and this is the All Country World Index. Now, it has tilted in favor towards the U.S. stock market, but does have developed and emerging markets. If you look at the beginning of the quarter, the Dow actually fell 9 sessions in a row and made up the longest losing streak since 1980. So if you felt like things were going poorly and you sold before the election, well, you missed the upturn. So, and Trump won the election here, and again, the market overnight was looking really poor, and the market finished relatively strong. So I'm going to pause it for a second and then show you 2016. Okay, so here is all of 2016. So U.S. stock market, as far as the S&P 500, was up 12.74%. Actually, this is the Russell 3000. I'm sorry, was up. It's almost the same as the S&P 500, though. It was up almost 13%. It was a good year. Now, I ask you to remember back to January and February of last year when people were panicking. The market was allegedly crashing, and it really felt, by the way, at the time that the market was crashing. I remember worst January, I think it was in the history of markets, and it was down somewhere between 17 and 19% in the first month and a half or so of the year. But once again, you're rewarded to stay patient and not to act. And so once again, we did not act. So there was a 13% return in U.S. stock market by itself. International developed, although it was down in the fourth quarter, overall had a okay year, up almost 3%. Emerging markets was up 11%, a big recovery year for emerging markets, and I'll show you certain segments of emerging markets really did well. Global real estate, I said before, it got trashed in the fourth quarter, but still if you held it all year long, almost 6%, and then bonds, although they got trashed in the fourth quarter, they still had a positive return. And what's amazing is the U.S. bond market did not do as well as the foreign bond markets did this time around. So diversification helped out. Okay, so Russell 2000 is the smallest companies, and value means the company's on sale. So if you tilted your portfolio towards small and value, you had a 31% return, almost 32% return in that asset class. This is all the different asset classes, or most every asset class that we believe that you should have a part of your portfolio. The Russell 2000 is just smaller companies, and there's 2,000 of them in this index, 21%. The Russell 1000 value was up almost 17, over 17. Emerging markets, value. Again, companies on sale, that's what value means. Very low price to book, almost up 15%. And then you can see some of the others. Emerging markets, I shared with you. REITs, U.S. REITs were up 6.68%. Now, if you left all your money in the bank, you got no return. And if you invested in 1-month T-bills, you got 1/5 of 1%. So the actual U.S. market makes up 54% of the investable universe in the world. And so if you only invest in U.S. stock markets, you're missing out on 46% of possible returns and diversification. But once again, the U.S. market, it's hard to argue with it. Small cap value, small cap, large cap value. I mean, it's hard to argue with this. Now, really interesting, for a number of years, the growthy companies, the sexy companies, the companies we expect to grow really fast have been beating value. Well, in 2016, value, which is the companies that are on sale, the slower, perceived slower growers, really did very well versus the growthy type companies. International developed makes up 36% of the market universe. International value, very nice, 7.39%. Small cap made up 4%. So, not terrible returns. The international developed stock returns, if history is any guide, they will have positive returns in the future. Again, if history is any guide. Emerging markets makes up 10% of the investable universe. Again, the value companies did fantastic in 2016. So, which countries did well? Well, it's quite interesting to me, because 2015, if you looked at Canada, Australia, New Zealand, these countries, the companies that are in these countries did very poorly. Why is that? Well, they have a lot of commodities and oil. And in 2016, by continuing to hold these companies in these countries, you did well. Now, we don't recommend you own any single country. We recommend you own all the countries and have a diversified portfolio. Emerging markets, Brazil and Russia, 66% in Brazil, 56% in Russia, and 55% in Peru, respectively. These were countries that got taken out to the woodshed in 2015. The thing about the dollar is that the dollar versus most of the currencies, the dollar was strong, and therefore foreign investment did not do as well in 2016. Now, we do not believe that you need to worry about currency when it comes to equities, because equity returns are so high that it all comes out in the wash. But for bonds, for foreign bonds, we do believe that we make sure that the dollar, strong or weak, doesn't affect bond returns. So that's how we invest money. Real estate investment trusts, 60% of the universe is in the U.S., 40% of the universe is outside the U.S. U.S. REITs, I've already gone over that, 6.68%. Global REITs, ex-U.S., 3%. So REITs did fairly well last year. They were having a banner year up until the fourth quarter. Commodities, don't really believe in investing in commodities, but it's interesting that oil, heating oil, zinc, sugar, silver, nickel, they all did pretty well. Natural gas came back, and then the wheats and the corns and the hogs, I have to say it, the hogs got slaughtered. Sorry, terrible pun. So this to Charlie and I is probably the most important page in the lesson, is that When we're unsure of the future, which by nature we are, we need to find the amount of risk return that's comfortable for us. And for example, down here, the dark blue line is 100% equities. And you will probably, and I use the word probably, we don't know for sure in the future if 100% equities will give you higher returns, but probably it will. But if you're somebody that does not pay attention to your investments on a daily, a monthly basis, and you're able to totally ignore it, that's perfectly fine. If you're like the majority of people, you may not want to have 100% equities. And look, the 75 and 25. Yes, it's less of a return, but it's also less of the bone crushing type of volatility. So we don't mind volatility on the upside. We care about it on the downside. So this is a good time, and Charlie and I are happy to talk about rebalancing portfolios. This is a good time to think about what is the right portfolio return going forward. 100% equities, by the way, in 2016 gave a return of 8.48%, and that would have been a global portfolio. 75-25 would have still gotten a 6.47% return, and 50-50 would have gotten a 4.42% return. So with that, we thank you for watching. Happy New Year. If we can do anything to help, please let us know. Have a great New Year.